Mr. D.I.Y entered Bursa Malaysia in 2020 with a market cap of over 10 billion ringgit. Today, it runs more than 1,000 stores nationwide. So, how did a simple hardware shop evolve into Malaysia's most successful retail listing? Mr. D.I.Y's journey matters because it shows how a simple, scalable business model can outperform market cycles. And for investors, it reveals how post-IPO execution, not hype, determines long-term performance. Mr. D.I.Y began in 2005 as a small hardware shop in Klang, a modest store selling everyday household tools. But even from the early days, the founders believed in one idea: making home improvement products affordable and accessible to everyone. That simple philosophy guided their expansion, and by 2014, Mr. D.I.Y had already reached more than 100 stores, long before most Malaysians realized it was becoming a nationwide retail force. Mr. D.I.Y listed in October 2020 at RM1.60 per share, raising over 1.5 billion ringgit. It immediately became one of the biggest IPOs of the decade, debuting with a valuation above 10 billion ringgit. The IPO promise was simple but powerful: rapid expansion, nationwide reach, and a low price, everyday value model designed for the mass market. What set Mr. D.I.Y apart was its engine behind the scenes. Over 60% of its products are private label, given the company's strong control over pricing and margins. A centralized warehouse system that keeps logistics efficient, and each outlet can stock up to 18,000 SKUs, one of the widest assortments in Malaysian retail. After listing, Mr. D.I.Y executed its plan with remarkable precision. At one point, the chain was opening new stores nearly every week, expanding into Mr. Dollar and Mr. Toy to reach new consumer segments. Revenue rose from just 2.6 billion ringgit pre-IPO to over 4.7 billion ringgit just a few years later. And during lockdowns, the business remained resilient because many of its products were considered essential household items. But rapid expansion brought new challenges as well. Operating costs increased, especially labor, rental, and utilities. Malaysia's rising minimum wage added further pressure to the margins. Same-store sales growth began to moderate, meaning Mr. D.I.Y relied more on new outlets to grow. Competition also intensified as other value retailers adopted similar formats. And while earnings remained strong, the share price experienced periods of volatility reflecting inflation concerns and shifting consumer sentiment. After listing at RM1.60, the share price climbed to RM3.60 at its peak, before normalizing in line with consumer trends. Today, Mr. D.I.Y remains one of the largest retail chains in Malaysia. The stock has seen periods of volatility driven by cost pressures, wage increases, and changes in consumer spending. But the company continues to report solid profitability and consistent expansion. The key lesson from Mr. D.I.Y's listing is that in retail, scalability wins. A simple model executed consistently across hundreds of outlets can outperform more complex strategies. Cost control, supply chain discipline, and operational efficiency became the company's true competitive edge. Mr. D.I.Y's story is still unfolding. Its next chapter will depend on how well it adapts to rising costs, tighter competition, and a maturing store network. As always, past success doesn't guarantee future results. But Mr. D.I.Y remains one of Malaysia's most influential retail listings, and its evolution continues to shape the consumer landscape. If you like this type of case study videos, hit the like and subscribe button.